Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 24th of May. I'm Daniel Lam, your host for the podcast. The US debt ceiling debate is now firmly the dominating macro factor in global markets. Last night, despite stronger than expected S&P Global Flash US Composite PMI, which captures sectors across both services and manufacturing, S&P 500 was very weak, opening at the highs and closing at the lows. This was because last night's negotiation talks did not yield any concrete progress. From the optimistic remarks from Biden and McCarthy the previous day, McCarthy reportedly said in a closed-door meeting after last night to his Republican colleagues that we are nowhere near a deal yet. The back and forth has left investors on edge in the countdown to the June 1st X date, which is when Yellen said the default is likely to come. Now, we spoke about our thoughts in the podcast yesterday that we believe the debt ceiling ultimately does get lifted or suspended, though the journey to that end could be at the 11th hour and drive significantly higher the market instability than being appreciated by the markets currently. We are starting to see more pronounced moves coming into different assets. So, for example, the DXY already broke above key resistance at 102.80. Now, technically, it seems to be heading higher to 105. A stronger US dollar in the short term has implications on gold, because usually a stronger US dollar weighs on gold. Moreover, whenever gold reaches 20 billion US dollar inflow over a 3-month period, which it had lately, then typically there could be consolidation over the following 1 to 3 months. However, if there were to be a confidence crisis in the US sovereign, i.e. threats of a US temporary default or credit downgrade, then gold is likely to benefit from such a scenario. So, for example, back in the run-up to the US sovereign downgrade in 2011, gold was one of the best performing assets, along with the Swiss franc and the Japanese yen against the US dollar. Now, at that time, gold was up 6% from the end of May to the US sovereign downgrade in August 2011. So we believe investors should be accumulating gold if there were to be short-term pullback. They could consider averaging in around the zone of 1870 to 1950. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.